Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending December 8th, 2023. Let's start with a look at this week's markets at the close on Thursday. Higher interest rates on the week. You see the price of oil here 6.8% higher on the week, so lots of volatility. Interest rates are very sensitive to oil prices because expectations for future inflation, what we call the break-evens, are kind of tied to the hip with the price of oil. So if you have a positive view on oil, likely break-evens will go higher, and that should put some upward pressure on interest rates. So we see this dynamic at play this week. So negative on the week for bonds, still positive on the year, and it's still possible, but it would be surprising to have a negative year for bonds. So good news here is that we have finally a good year, positive year on bonds. When you look at the stock market, the TSX outperformed. The CAD was so strong that bringing everything back into Canadian dollars give you negative returns for other equity markets on the week. And the price of gold, pretty volatile recently. We touched 2100 briefly, fell back down, now back up to 2072. So lots of volatility on the price of gold again. So this week I'll focus on the Bank of Canada. We had a decision this week. No change was made, but signals here are important to read, and especially because we believe that central banks, developed market central banks, will be cutting rates in 2024, pretty much all of them. The question is when and how quickly. Bank of Canada should be one of the major central banks to cut, maybe one of the first to cuts. We think that the ECB is positioned to start cutting pretty soon in 2024. Bank of Canada should follow suit somewhere around the middle of the year. Here, what you see here is some extracts from the statement from the Bank of Canada. They said that the data show that the economy is no longer in excess demand. This is central bank jargon for saying that the economy is not overheating anymore. It's more balanced. The economy is no longer in excess demand, but they're still concerned about risks to the outlook for inflation, and they remain prepared to raise policy rates further if needed. So this is a statement that was in this is a sentence that was in the statement for most of this year. It's time to retire this statement in early 2024. So we're looking at the next decision date, which will be on January 24th, 2024, as a moment where they should retire this and explain in more details why it's time to stop keeping this tightening bias in. They'll be talking about multiple things: the labor market, the housing market. They'll talk about their policy in more broadly with what they do with the balance sheet, but likely in early 2024 they will start by retiring this, giving some context, giving some guidance, and then after that they will be set up correctly for eventually cutting rates through the year. They said that they want to see further and sustained easing in core inflation, so we've been seeing some good things there. Wage inflation is still an important number here because it causes lots of inflationary pressures in the services sector, which is the dominant sector in the Canadian economy. So that's still an important one. And corporate pricing behavior, that's the thing also that will be in focus. So if we look at what the market is pricing for 2024, here we see that cuts are priced starting around mid-year, and by the end of the year it's about 3 to 4 cuts. So it's not like rates will go from 5% back to 0. So we need to go back to a neutral rate. The neutral rate is at 2.5 and we're at 5. So there's some wiggle room here. The Bank of Canada can start easing slowly. What that means that monetary policy will be progressively less restrictive. It won't go from a restrictive to easy instantly, and certainly not in 2024. It's going to likely take a few years unless we do have a deeper recession and we have bad economic surprises. But the base case is that it's going to be progressive. So what will the Bank of Canada look at in 2024? What will it discuss most likely? Well, here are a few things. On the left, you have wages again. Wage pressures. Typically, wages react to the current state of the economy, but also are forward-looking. So employees are negotiating better wages when they see the economy is booming. So this is coincident, but also when they're expecting stronger inflation ahead, they will be more aggressive in their negotiation, thus pushing wage pressure higher. Here, though, it's something else because we've had such a strong bout of inflation during the pandemic, and we see with all of the strikes, we have some strikes of the public sector in the province of Quebec, for example. Have you seen with the auto producers in the US? It's more to correct the loss of purchasing power that came from the recent bouts of inflation. So that kind of muddies the picture. For the Bank of Canada, they need to dig into that and to make up its mind about what is wage pressure that is tolerable in this environment. They've been talking about 4 to 5% as being too hot, and we're stuck at 5% here. Likely they will change their tone at some point. Likely they will guide us on this. It should be in early 2024, maybe as early as January. And on the right, you see the size of the balance sheet. So the Bank of Canada did some quantitative easing during the pandemic, some QE, bought lots of bonds on the open market to keep rates lower. Now they're fading out this monetary policy tool that they have. And as you can see, as a percentage of GDP, more than 50% has been unwound. So that's been lots of tightening in the background that's been happening. Now that they're at this moment, maybe it's time to start cutting the interest rates while you continue to do that. So have to have a more balanced picture within the monetary policy. So it's a thing that they could be favoring, but of course they will be taking into account the state of the balance sheet as a determinant factor as to when and how to start cutting rates. So two very important elements here. And of course we can't avoid it. Housing, there was a speech by Deputy Governor Tony Gravel on yesterday about the housing market. I recommend that you give it a read if you're interested in such things. But here are two things. You see that the 5-year mortgage rate continues to rise. So we feel the tightening of monetary policy in the housing market for sure. Mortgage rates don't have to rise until there's a rate cut. If the market starts to anticipate rate cuts that are imminent, we could start to see mortgage rates fall ahead of that. It's based on, it's influenced by market rates, but for now it's still going up. And on the right, even though mortgage rates have been moving higher, we see that we've had a drawdown of 11%, then the market rebounded, and now we're starting to see a little bit of a pullback. So it's the clash of titans here between demography and interest rates. So far, demography seems to be punching above its weight, I would say, but you see that now that the trend has been lower. So what happens in housing in 2024 should be a very important variable for the Bank of Canada. So lots of things here to look at. And I'll close here looking at the US. Same chart on the right as I've shown for the Bank of Canada. As you can see, markets are pricing about 5 cuts by the Fed in 2024. But look at the latest data points. You see a little bit of a rebound here. Was because this morning we got the labor market report in the US. Unemployment was on the rise. Now it fell a little bit during the month, and the market suddenly is slightly less convinced that the Fed will go with as many hikes. So you see the nervousness here in this indicator, which comes from what happens. More importantly, from the labor market. All macro indicators have some weight here, but the labor market is the dominant factor. Unemployment rate went from 3.9 to 3.7. Is it the change of trend or some volatility along the trend? Likely it's the latter, but still markets are very nervous about what goes on in the labor market. So it's not clear yet when and how the Fed will start cutting, but likely they will get moving in 2024. So what to watch next week? We'll have manufacturing sales, existing home sales, and housing starts in Canada. In the US, we'll have CPI inflation, the rate decision by the Fed, no change expected, and retail sales, which should come in, again, slightly negative on a monthly basis. So that wraps it up for the week. ia.ca/economy, iagam.ca/insights. Lots of material there to follow us. It's always a pleasure to serve you, and I'll see you again next week.